Imagine the entire U.S. economy as one enormous game. More than 340 million players, trillions of dollars moving. One question underneath everything: who gets what and why? Economics begins with scarcity. We have limited time, money, land, workers, and machines, but nearly unlimited wants. Maya is 22. She has 2 free hours: study for tomorrow's exam or watch Netflix. Choosing Netflix costs more than the subscription. It costs the grade she might have earned. That sacrificed next best choice is opportunity cost. Every decision has one. Scarcity creates trade. James is 28, works a corporate job, and runs a YouTube channel at night. He can edit a video in 6 hours, or hire an editor who does it in 2. Even if James edits well, his time may be better spent writing and earning at his main job. People and countries specialize where their opportunity cost is lower. That is comparative advantage. Then they trade, and both sides can gain. Now enter the market. Millions of buyers and sellers responding to incentives. Suppose a hurricane shuts Gulf Coast refineries. Gasoline supply falls. At the old price, drivers want more gas than stations have. Prices rise. Some people drive less, suppliers search for more fuel, and eventually quantity demanded meets quantity supplied. That meeting point is equilibrium. High prices hurt, but they also carry information. Conserve this, produce more of this. A strict price ceiling may make gas seem affordable, yet if set below equilibrium, it can create shortages, long lines, favoritism, or illegal resale. Policy can help people, but incentives do not disappear. In 1776, Adam Smith described the invisible hand. People pursuing their own interests can unintentionally coordinate production through prices. Not perfectly. Pollution, monopoly power, fraud, and unequal access can break the result. Markets are powerful tools, not magic. But how does everyone trade? Barter is awkward. If you have corn and want shoes, you must find a shoemaker who wants corn right now. Money solves that double coincidence problem. Americans have used commodity money, metal coins, paper notes, checks, cards, and digital balances. The form changes, the foundation does not. Trust that others will accept it. Money is a medium of exchange, a unit for comparing value, and a way to store purchasing power. Deposit your paycheck, and the bank does not usually lock every dollar in a vault. It holds liquid assets and reserves, then funds loans and investments. When a bank makes a loan, it generally creates a matching bank deposit, expanding deposit money. But this is not unlimited money from nowhere. Capital rules, liquidity needs, credit risk, funding costs, regulation, and demand for sound loans constrain banks. And an important update. Since March 2020, the Federal Reserve's required reserve ratio has been 0. So the old story that every bank must keep exactly 10% is outdated. Banking still depends on confidence. If everyone demands cash at once, even a solvent bank can face a run, because long-term loans cannot instantly become cash. That is why regulation, central bank liquidity, and deposit insurance matter. The FDIC generally insures eligible deposits up to $250,000 per depositor, per insured bank, per ownership category. It covers deposits, not stocks, crypto, or mutual funds. How do we score the whole economy? Gross domestic product measures production inside the country. The spending formula is C plus I plus G plus NX. Consumption, private investment, government purchases, and exports minus imports. In 2025, U.S. nominal GDP was about $30.8 trillion, the world's largest at market exchange rates. But size is not everything. Living standards grow mainly when productivity rises, meaning each hour of work produces more value through skills, tools, technology, and better organization. GDP also has blind spots. Elena spends all day caring for children, cooking, and managing her home. That work is valuable, but because no market transaction occurs, most of it is absent from GDP. If a factory produces goods while polluting a river, output raises GDP, while environmental damage is not simply subtracted. GDP measures production, not happiness, fairness, or sustainability. Then comes inflation, a broad rise in prices that reduces money's purchasing power. Say your salary rises 5%, but rent, groceries, and other prices rise 7%. Your nominal income is higher, your real buying power is lower. The number grew, your life did not become richer. As of June 2026, the Consumer Price Index was 3.5% higher than a year earlier, although monthly moves varied and inflation differed across categories.
The Federal Reserve tries to support stable prices and maximum employment. Its main lever is the federal funds rate. Higher rates usually make mortgages, car loans, and business credit more expensive, cooling demand and inflation, but also risking slower hiring. Lower rates can support spending and jobs, but may add inflation pressure. The effects arrive with delays, and the Fed cannot manufacture oil, homes, or eggs. Government has another lever, fiscal policy. Federal income tax is progressive. Higher slices of taxable income face higher rates, not your entire income. State and local sales taxes can be regressive because lower-income families often spend more of each dollar they earn. And the person sending a tax payment is not always the person carrying its true burden. A business tax can partly reach workers through wages, owners through profits, or customers through prices. When federal spending exceeds revenue in one year, that is a deficit. To finance it, the Treasury sells bills, notes, and bonds. Accumulated borrowing becomes national debt. Debt can fund emergencies and useful investment, but rising interest costs can squeeze future budgets. A country is not a household, yet borrowing still has trade-offs. America also trades with the world. Imports give consumers variety and lower prices. Exports support U.S. producers. Tariffs can protect selected industries or address strategic risks, but they are taxes on imports, and much of the cost may reach American businesses and shoppers. Trading partners may retaliate. Protection can save some jobs while raising costs or threatening others. Exchange rates change the picture. When the dollar strengthens, imported phones and overseas vacations become cheaper for Americans, but U.S. exports become more expensive abroad. When the dollar weakens, exporters and foreign tourists may benefit, while imports cost more. The dollar remains the leading reserve currency. IMF data put it near 57% of global foreign exchange reserves in late 2025. That creates enormous demand for dollar assets, but it is not a permanent law of nature. The labor market is also supply and demand, except the product is human time. Why can one worker earn 10 times another? Skills, scarcity, productivity, bargaining power, risk, location, discrimination, and replaceability all matter. Unions can raise worker bargaining power. Minimum wages can lift pay for affected workers, but the effects on hours, prices, and hiring depend on the market and the size of the increase. Automation and AI can remove tasks, create new ones, and shift rewards toward people who complement the technology. The tension is real. Progress can grow the pie without dividing it evenly. Finance moves savings toward future projects. A stock is ownership in a company. A bond is a loan. Derivatives are contracts whose value depends on something else. They can hedge risk or magnify it. Crypto assets offer new payment and ownership experiments, but prices can be extremely volatile, protections vary, and critics question many projects. Higher possible return usually means higher risk. Diversification cannot prevent every loss, but it reduces dependence on one bet. As Warren Buffett often emphasizes in practice, understanding what you own matters more than excitement. And humans are not perfect calculators. Behavioral economics studies shortcuts and biases, panic selling, following crowds, valuing a dollar differently depending on its label, or choosing an expensive payday loan because Friday's rent matters more than next month's interest. Poverty itself consumes attention. Research associated with economists Abhijit Banerjee and Esther Duflo shows why small constraints, missing information, health shocks, and unstable income can reinforce poverty traps. Bad outcomes are not always bad character. Sometimes the choice set is brutally narrow. So, which system wins? Capitalism uses private ownership, markets, and profit to drive innovation, but can produce inequality and market failure. Socialism gives government or society a larger role in ownership and distribution. Communism, in theory, seeks common ownership and a classless society. In practice, centrally planned regimes have often concentrated political power and struggled with information and incentives. The United States is not pure capitalism. It's a mixed economy, private companies and competitive markets alongside social security, public schools, regulation, taxes, central banking, and safety nets. The real debate is not market or government, it's which tool works best for which problem with which trade-offs. That is the American economy. Scarcity creates choices, prices coordinate them, money and banks move purchasing power, productivity builds wealth, and policy redistributes risks, and every solution changes incentives somewhere else. This video is for educational and awareness purposes only. It is not financial advice. If this made the U.S. economy finally click, hit like and subscribe.